Okay, so welcome to this fantastic event. Actually, I'm super glad of having MEB FABER here. And actually, he's opening this event. And for me, it's a pleasure because MEB FABER is one of the greatest investors that have made a lot for investors regarding education. Actually, he empowers investments. This is I'm going to quote in this case Wesley Gray, that is another speaker in this event. And so by saying that, he empowers investors through education also. He has authored numerous white papers and many books. He's a frequent speaker and writer on investment strategies and has been featured in Barron's, the New York Times, and the New Yorker. Mr. FABER graduated from the University of Virginia with a double major in engineering, science, and biology. Mr. FABER is a co-founder and the chief investment officer of Camry Investment Manager. Actually, I'm super glad, as I tell you, and I don't want to brag here. You know, I think this is his moment, and I hope that all of you guys enjoy a lot, as I'm gonna do. MEB, welcome of being here. It's a pleasure.
Great to be here, though I would much rather be there. But that so is 2020. Looking forward to hopefully 2021 getting to hang out in person for sure.
Actually, I remember that prior this COVID thing, this pandemic thing. So we were talking about that, and you were supposed to come here, but eventually we couldn't do it. So. Okay, this is also good, MEB. So I'm super glad. Okay, so I don't want to brag here, so go ahead with the presentation, MEB, and then later on we will answer some Q&A.
Awesome. Well, I certainly miss Spain, eating dinner at 11 p.m. at night and going out for some wine. So we'll have to do it again sometime soon. So let me try to do a share screen and we'll get started. Try this guy. We'll see how this works.
There you go.
How are we looking? Is it looking okay?
Yes, perfect.
Awesome. All right. So this is my view at the beach. I'm not really in the mountains, but we're located here in Los Angeles, California, and things are a little smokier recently. But otherwise, let's talk a little bit about the way the world looks. 2020 has been a bit of a interesting year thus far, and really the start of a decade. I had a tweet at the end of last year and said, you know, many times throughout history, decade ends really had a defining inflection point for markets. In the 80s, it was the Japanese boom. In the 90s, ended the US boom. The 2000s, everyone remembered, ended with the global financial crisis. So I wonder what 2020 is going to bring, and wasn't really expecting that to all happen in the first 2 months, but it feels like an entire decade wrapped in 6 months, 8 months. We'll see what the next 3 months have to bring. But as you look out towards the next decade, we're really thinking about sort of two scenarios, and we're going to talk about this today, which is, you know, what's the world look like today? And if you think back to March, felt like the world was ending, but we had done a post. It was a 4-part series. It was called the Get Rich Portfolio, the Stay Rich Portfolio, Investing in a Time of Coronavirus, which was sort of near the bottom in March. And the last one was How I Invest My Money. But the point I made in that article, and you can find it on my blog at mebfaber.com, is we laid out being an investor, you know, we always say you got to study history, but also to have a foundation of what's possible, but also to envision future market scenarios that don't necessarily agree with your worldview. Because we all know the markets have a way of making us all look very foolish, the professionals, all the way across the board. And so we had made a point that said, look, you have to at least envision, if you're the most bearish person on the planet, you think this is going to turn into the zombie apocalypse, you have to at least envision the bull case. You know, vaccines coming online, treatments available, healthcare systems all around the world handling the crisis well, and markets hitting new highs by year end. No one could envision that, right? I mean, if you think back to March, how crazy that sounds. And on the flip side, you had to envision at least the possibility of this not being handled well, where governments were inept, treatments are ineffective, the virus mutates in the fall and it gets worse and things snowball and there's a huge second wave, third wave, yada, yada. The whole point being is you have to at least consider the possible outcomes. Now, this applies throughout history. It's particularly useful right now. And so we wrote this in March, and here we are, sure enough, in many markets, particularly where I sit in the United States, hitting new highs again. And that's crazy to think about, particularly this disconnect I think a lot of people feel with sort of Main Street versus Wall Street. So we're going to talk about this real quick today. What does the world look like? How do you prepare for that possibility of a right tail sort of outcome? Same thing, the left tail, we're talking about sort of a distribution, a really good upside event, a really bad left side event, and then we'll just chat. Okay, so as you look back to stocks, is one of my favorite little graphics. Illustrations also say much more than words could, but how do most people, institutions, project what something, an investment will return in the future? Simply, they usually extrapolate what's happened in the past. And you look at every institutional fund, pension fund, endowment in the United States, they often sort of average around 8% per year, but that's simply because that's what stocks have done historically. Now, is that a reasonable estimate? You know, if you think about bonds, if you had a bond yield that was 10% in the past and now it's at 1%, you certainly wouldn't expect it to return 10% still, but that's what people do with stocks. And so I think it's a good anchor. Say, look, that's a reasonable, at least historically, what they've done, but can we improve that forecast? And so there was a formula proposed in the 90s. It really goes way back, but John Bogle, you know, the head of Vanguard, RIP, Jack, he had written a paper that talked about a very simple formula for forecasting stock returns. Now, he wouldn't call it forecasting. He would say maybe giving you expectations. But there's only 3 variables, what stocks are going to do the next 10 years. The first is the starting dividend yield, 1, the earnings and dividends growth for the next 10 years, 2, and lastly, change in valuation. So we have a nice history here of U.S. stock returns, U.S. stock valuations, and here we're using the 10-year price-to-earnings ratio. And this goes back, Professor Schiller took this back to the 1800s. It's nothing more than a 10-year average adjusted for inflation. And as you can see, it's now known as the Shiller-Cape ratio. And this usually causes people's brains to misfire a little bit, but it's a very simple, crude measure. And it's been around since the time of Ben Graham. He based it on some of Ben Graham's writings, which said you can average out for a security 5 to 7 years of earnings. That way you can kind of get an average of the expansions and contractions, and it's a little less noisy than just, say, a 1-year measure that most people use. So as you can see from this chart, there's been many times it's been low single digits, as low as 5. And then a few times it gets into the 30s, and then even the 40s. It hit almost 45 at the peak .com bubble. That was my favorite bubble. I was finishing university at the time. Anyone can remember back to that time. I was trading stocks during engineering class, but it wasn't only me. My professors were trading stocks. Everyone was talking about stocks. There's definitely some echoes with today. Have a lot of people showing that renewed interest with the Robinhood traders and Reddit, Wall Street bets, a lot of these discussions going on that you see during euphoric times. But the whole point of this chart is that valuation kind of moves all over the place. And this is simply what people are willing to pay for stocks. It may be justified, it may be not. The long-term average is right around 16, 17. In low inflationary times like now, and that's sort of 1 to 4% safe zone of inflation, you have the average is closer to 21 or 22, which has actually been the average of the last 40 years. Where are we today? We're in the low 30s, which historically has been pretty high. So back to Jack. Don't let this chart scare you, but this is a if thinking about being a good investor, you have to think almost like a gambler or speculator. And anyone who's played blackjack or 21 or poker, you know that you're making logical bets or betting on sports, but the outcome is never certain. So you have these uncertain outcomes, but at least you can try to narrow it down based on probable distributions. And this won't get you invited back on CNBC. But here's what we could look at with, say, for example, U.S. stocks as a sample. So you can look at the starting dividend yield. That's known. That variable, I'll be optimistic. I'm rounding up just to make this simple to 2%. The valuation is known. I'm rounding down again, I think we're around 32, but let's call it 30. So we'll call earnings growth, dividend growth, same as history, which depending on your perspective could be optimistic or pessimistic, but we got to project out where do valuations in the decade. 2030, when you guys have me back on, we're hanging out in Madrid or Barcelona or San Sebastian, somewhere, 2030, we're going to say, was MEB right? How did he look? And we may be doing it via hologram at that point, but so you can come up with scenarios. What's the most likely scenario? Most likely scenario, valuations sort of drift back down to long-term average, which is around that sort of 17 to 21 safe zone, in which case valuation multiples contract, huge headwind, and U.S. stocks will return, and this is nominal, 1 to 3% per year. So not great, but not horrific. Not a bubble in my mind, not totally crazy like there were in the internet bubble, but certainly not good. And lest you think I'm a total pessimist, Debbie Downer, well, Jack Bogle, before he passed, he said he expected U.S. stocks to do about 4% per year. So, but what happens if things sail right back through, I don't know, the things back to the Corona discussion earlier, and valuations go back to 10 or 5, well, then you're looking at pretty big headwinds and stocks are going to return minus 5 to 10% a year. But you have to at least consider the possibility that valuations stay flat or valuations even increase, in which case you get sort of the 7 to 11% zone. Now, the problem here is expectations. Survey after survey after survey shows that people asked about their investing expectations. So you have, I mentioned already, all the pension funds out there who expect 8%. Individuals and institutions around the world almost always expect 10%. There's a Schroeder study that said the US was actually the most optimistic country in the world today. Investors expected 15% per year going forward. For that to happen, not only do valuations not decline, not even stay even, they have to go up. So you have to have these animal spirits increase to the point where you had valuations that were the highest in history or higher. And so is that possible? Yes. Is it probable? Absolutely not. And historically speaking, investing in high valued markets, you have a much bigger chance of a big fat drawdown or loss in the ensuing 5 years. But so if you're thinking about as markets romp up, how do you sort of approach this mania potential? You know, I don't think it's a mania now, but how would you approach it if this continued? Elon Musk finds, the moon is made out of diamonds and free energy at its core. Who knows? There has some sort of optimistic outcome. How can you approach it? Okay, so this is from a U.S. perspective, but it's useful. You'll see in a minute as to why. If you go out and bought the entire world, doesn't matter where you're sitting, in Spain and Australia and Japan and Los Angeles, this is what you would end up getting. If you said, I'm just going to buy every stock in the entire world, you end up with, it's now almost 60% US, just because the US has had a massive run this past decade. You get a smidgen in emerging markets, around 12%, and then the rest is a smattering of every other country in the world. And this is just called market cap weighting, right? This applies in every stock market or a sector. If you just were to buy the entire market cap, this is what you get. Well, no one actually does this. This is a good chart from Vanguard that shows home country bias by country. And what does that mean? Well, it means that no matter where you live, you put all your money into your own stock market. So if you're in the US, if you're in Canada, certainly Spain, Aussie, Japan, our Brit friends, people put most of their money in their own stock market. And I'm of the belief that this is a really, really foolish idea. And the reason being, I'm a quant. And so you have a world of choice, tens of thousands of securities all around the world. Why would you constrain it to just one market? Now, people give a laundry list of explanations, most of which I think are fairly terrible. They understand local stocks. They feel comfortable, gives them the warm fuzzies. But it, in reality, actually gives you an extremely concentrated bet into one country, which I think is really foolish. Here's a chart. If you go back, I think we were the first to do this, but now there's a lot of other people that track CAPE ratios. We did this for 45 countries all around the world in our book, Global Value. You can download that for free online. And what this shows in this example is the US chart we showed earlier. This is the blue line. And then the rest of the world is the red line. And so that's without the US. And we've done this for all the individual countries. And what you find is a lot of people, particularly in America, but this happens everywhere when you have a long period of spectacular or terrible returns, is people love to extrapolate into the future. They say, whatever happened recently, this is going to happen forever. And the reality of that, we have a pinned tweet on my Twitter profile that shows the top 6 institutional research pieces about investing globally in stocks. And we'll mention a few of them here. But what this demonstrates is over time, valuations zig and zag. I often ask investors here when I'm giving talks, and these are like multi-billion-dollar pension funds, endowments, and they say, well, here's all the reasons why the U.S. is exceptional in certain regards. It deserves the valuation premium, which you can see now where the red line is much lower than the blue line. And I say, well, what do you think that historical premium should be? And they come up with a number. And the answer is there isn't one. The U.S. and the rest of the world has had an average CAPE ratio, again, back to 1980 of around 22. And all of the multiple expansion has really come since 2009. Pre-financial crisis, you had the same valuation. So these tend to zig and zag. We did an article called The Biggest Valuation Spread in 40 Years. If you go back 40 years, the rest of the world was really expensive and the US was cheap. Now, this is dominated by Japan. And at various times, you have various countries that are much more expensive than others. If you guys remember back to the pre-financial crisis, the big interest was in emerging markets, the BRICS, Brazil, Russia, India, China. India and China were trading in valuation ratios in the 40s and 60s, so higher than the US was in its bubble, and have had fairly tepid return since. But Japan is the example of the biggest granddaddy bubble of all time, where they hit a valuation of almost 100. So if you're a listener who experienced that, you can remember and recall just how crazy that was. If you're not, I suggest becoming a student of history, because Japan was the world's largest stock market at the time. So if you were a global investor, this is one of the faults of market cap weighting, is that it is valuation agnostic. So you end up putting most of your money into what's going up and is the biggest, and the biggest is often determined simply by the P going up. So in the 80s, you put most of your money in Japan when it traded the highest valuation of any country we've ever seen. The Japan stock market is still not back to where it was in the 1980s. How crazy is that? 30 years. And this isn't some tiny economy. This is still a top 5 economy in the world. And so these huge valuations have a massive headwind for many years to come. And you're seeing a huge dispersion today. It just happens to be the US, which is the world's largest stock market. We track 45 countries around the world for valuations. And the US is one of the most expensive. Again, it's not as bad as it was in the 90s, not as bad as Japan was in the 80s, but it's not good. The good news is the rest of the world is cheap. So here's some updates. This was in June, so these have moved a little bit since, but it's ballpark correct. US is in the low 30s. Foreign developed, the average country is in the high teens, which is totally reasonable. Foreign emerging, downright cheap. Emerging markets are one of my favorite places to invest for the next decade. And then the cheapest bucket, which is out of the 45 countries, it's about 12, gets you to a valuation PE of around 10. Now, there's certainly a lot that are in single digits. There was even more in single digits in March. You guys will recognize some of these flags, a lot of red, whites, blues, yellows mixed in there, but a lot of these countries. And by the way, when we talk about valuation, if anyone's brain is totally melted at this point, valuation is a very blunt tool. It plays out in periods of years and decades, certainly not days, weeks, and quarters. And the actual valuation metric doesn't matter. So if you focus on CAPE ratio and you start going crazy, you can use dividends. That's fine with me. Price to book, price to sales, cash flow, anything. They should all say the same thing. When you have a country that's expensive like the US, every metric should say that it's expensive, which they do. If you have a country that's super cheap like Russia, every metric should say that they're super cheap. Now, this is two parts of investing on valuations, and we show this in our books. This is a big tailwind. It increases returns over time, but it's equally important everyone always focused on buying the cheap, like the Warren Buffett, right? You want to buy what's cheap, and that's all well and good. But equally important to the success of this strategy is you're avoiding what's expensive. The really stupid mistake of investing at the US at a 45 valuation in 1999, investing in India and China in the mid 2000s when they were at 60, investing in Japan at almost 100 in the 1980s, that ended up being huge drags on returns going forward. So buying a basket of the cheap stuff, going back, there's a great piece by Bridgewater. The US was outperformed the global average, global GDP weight, all the average of stock markets in the 2000s, but that's not normal. In fact, that's only happened a few times for a decade, going all the way back to the early 1900s. It happened this past decade. It happened in the 90s. And before that, it hadn't happened since the 1920s. So extrapolating one market regime, I think tends to be pretty painful. So we have a fund that does this. I'm not going to really spend any time on this, but the reason why I'm including it in this talk, there's some disclosures you guys can spend some time on, is that for any investor, it's just a demonstration in my mind that, and we manage 11 ETFs. We have over 50,000 investors, but you can do this with any fund. This is specific to Morningstar, one of my favorite sites, but there's plenty of sites that do things like this. Just to show you guys don't have to believe me, you can go type in any fund you want into Morningstar, and it'll show you the statistics for that fund, for valuations, for growth, for dividends, et cetera. And so in this case, our global value fund goes and buys the 12 cheapest countries of the world according to our valuation metrics. So it ends up in scary places that a lot of people would not feel comfortable investing in. But you get a basket of these countries. And so, but just for comparison's sake, I wanted to show you all these valuation metrics. And this, again, the category ends up being, I believe, foreign, small, mid value. But this super deep value approach, was historically has added percentage points on and above market cap weighting. And by the way, there's some really great research that shows when you invest in the largest company by market cap weight in a stock market or a sector or the entire world, it goes on to underperform by about 3 percentage points per year for the next decade. And the reason being is that market cap weighting has no tether to fundamentals. And a lot of people forget that. You're simply investing in what's the biggest and what's gone up the most. Well, a value approach, it's, again, this stuff isn't rocket science. The reason why the PE is often cheap in countries all around the world is simply because the PE has gone down. So you look at the basket of the most expensive countries, they're often hitting new highs. You look at the basket of the cheap countries, like right now, they're often still down 40, 60, 80% from their highs. So anyway, if you're looking at all these metrics, you can see that the basket of the really cheap stuff is massively lower than the S&P 500 and even massively lower than the general category. You get much higher dividend yields, cash flow metrics are better, price earnings, price book, yada, yada. Again, just wanted to show you a real world example because I think it's interesting. So quick summary, as you think about stocks, a lot of people want to think in binary terms. I'm in, I'm out. This is a bubble. It's got to crash, or it's the best time to invest ever. I got to put all my money in stocks. Try to be a little thoughtful about the possible outcomes. If you're going to do equities, and consider that you may have, and this is what we all want in the long term, is exposure to businesses, investment in those companies over time, but at least be mindful of valuation. And the beauty of using valuation is it gives you an anchor to say, is this reasonable? Let me have some perspective on what the world looks like today. So there's good and there's bad news. The bad news is the biggest country in the world, most of the world's market cap is expensive. It's not terrible, but it's not great. The better news is the rest of the world is reasonable to really cheap. So if you're going to do stocks, consider at least starting with a market cap weighted portfolio, move away from your highly concentrated home country bias, wherever you may be in the world, and then consider tilting towards value. GDP weight, things like that are also sensible. The US is only a quarter of the world's GDP. So coming up with a global value exposure, I think still could do double digits if you go back to Bogle's equation from the beginning, but start to plug in the metrics for the cheap stuff. With instead of a 2% dividend yield, you have 4. Instead of a CAPE ratio of 30, you have 18 or 12. Well, you can see how that plays out. You end up with much higher returns a decade hence. So as you think about markets going up, you want exposure, in my opinion, to the right tail, and the right tail, I think you want exposure to value. I'm going to pause real quick and we'll keep going. How we doing?
Excellent, Meb. Actually, it's super interesting. What I see is this idea of avoiding the country bias. This home country bias is awesome because it happens. It's something like very often people is not aware about this, but it's something that comes in handy, and a lot of people invest in this in their own. I mean, the stocks that are in their own country. So, but this idea of diversifying geographically, it's really interesting. And as I reckon, your secret sauce within another factors and stuff is the value factor. So how do you manage the pain of the value factor? Because over the last decade, for instance, this factor has underperformed dramatically in respect, for instance, to the growth factor or momentum or whatever. So what would you do to manage this this pain that this strategy could bring?
I mean, like a 50-50 combo of sadist and masochist. You know, I think there's two parts to this answer that I think are helpful. The first is we encourage all investors of any stripe to study history. My favorite investing book is Triumph of the Optimist, which gives a broad perspective of 120 years of markets with stocks and bonds and inflation and bills, and at least gives you some idea of what can and has happened. And with that knowledge, you still look to the future and say, I understand that things will be different in the future, better and worse. That's just the definition of how things work. And so coming into this year, as a great example, you had the fastest ever in the United States from a all-time high to bear market, and then vice versa, the fastest ever from bear market to all-time high. That had never happened before. Just like 2017, we had the longest streak, which no one would have predicted after the last election, of up months in a row for the stock market. You'd never had a calendar year where every month was up, and that happened. So the future will always be different and always surprise you, but at least you have some sort of lens of which to view this. Otherwise, you're just flying totally blind and don't understand the possibilities. Let me give you an example. We have a lot of investors, and often they'll email or call me and they say, hey, Meb, I bought one of your funds. And you mentioned, by the way, the two pillars we traditionally base our ideas on are value on one side and then momentum and trend on the other. Those go back 100 years. It's nothing new. It's the time of Charles Dow and Ben Graham. But they'll talk to me and say, Meb, I bought whatever your fund may be, 3 months ago, it's down or it's underperforming. I'm going to give it a few more to see how it goes. But how long do you think I should give it? And I used to say, when the world was normal and we'd be at a cocktail party or dinner or having a coffee or whatever it may be, I used to say 10 years, and they would laugh nervously. And I would say, I'm serious. I think this fund could, you need to give whatever strategy you allocate to, not even a strategy, an active strategy, but an asset class. So you got to give it 10 years. And they would say, well, that's crazy. And the funny thing is now is I actually say 20. And, people want the certainty of whatever strategy or asset class, right now, today. We live in a world of instant gratification. Everyone checks their phone 50 times a day, if not more. You can check out stocks on your online account every second to see how they're doing. But if you look at the history of markets, that's not how this works. That's not how any of this works. It doesn't matter if your asset class is gold or if it's bonds or if it's stocks, whatever, or if it's an active strategy like value. And let me give you an example. In March, and I was tweeting about this, I said, there is no single universally held belief than stocks outperform bonds over time by investors. I don't know a single person that doesn't believe that. And I can't think of a belief that's more universal than that. And yet, if you ask people, how long do you need to give stocks to outperform bonds? Most will say, 3 years, maybe 5. That's their expectations. In March, in the US, stocks had underperformed, same performance essentially, had the same performance as long-term bonds in the US for 4 decades. not 1 year, not 2, not 5, not 10, 40 years. And yet people are over here talking about, hey, I'm going to, give your fund or strategy or idea a few months. And so if you don't have that perspective on how long these regimes need to play out, you're going to get into the problem that almost every investor struggles with. And this is not just individuals. The institutions love to dunk on the individuals and say, oh, you're so irrational. Look at you on Robinhood. And yet these institutions make just the same mistakes. They just have fancier descriptions for them. They have committees, they have long policy portfolios that sound fancy, but in reality, most of the academic literature shows they chase performance just like individuals do. And you can look at all the drama over the past decade in two of the biggest institutions in the world, CalPERS as well as Harvard Endowment, et cetera, and show how challenging this task can be of managing investments. So the first piece of advice for investors is you want your money working for you. And so a starting point we always tell people is to buy the global market portfolio. It gives you massive diversification, tens of thousands of securities. And what does that look like? It's about half in stocks and about half in bonds. Of that, about half is in the US and half is ex-US. And that may be too much US for people outside the US, and that's fine. You can tilt away either way. And it may be not enough US for people in the US, which is crazy. Most people we see in the US put about 80% in US stocks of the stock allocation. They have zero foreign bonds. But my approach is that's the starting point. If you're John Bogle, the only true global index portfolio is that portfolio. Now, there's good news is that portfolio crushes it. It's a great portfolio historically. In our asset allocation book, we showed all these different portfolios over the past 40 years, how they've done. And they all do great, as long as you have some stocks, some bonds, some real assets, being commodities and real estate, those portfolios do just fine. And the beauty of it being 2020, the one good thing about 2020 is you can buy that portfolio for zero. It costs nothing. You can buy a basket of ETFs for essentially like 0.05%. And if you include the fact these fund managers that are the good guys like us, I think Vanguard and others do it too, they do some short lending on the portfolio and return that revenue to the shareholders, that portfolio is essentially free. So that's the starting point and a beautiful place to be. It's amazing to be an investor. Now, if you want to go get weird and move away from that and use thoughtful things like value, like trend or momentum or all these other things, and you're going to pay some more to do it, you at least need to be concentrated. And most managers, because of career risk, because they manage $50 billion and it makes no sense for them to be different, won't do it. So you have the weirdos like us, some of the other speakers you have this year certainly fit that category of being a bit non-traditional philosophies. But this is kind of a long-winded intro into one more part of this talk, and then we'll wind it down, which is, the goal of all this is to keep your money working for you. You want to invest in businesses. Ideally, you invest, you put it away, you forget about it, you're not mucking around with it. But people are also human, and human being blessed with emotions is a wonderful thing. But we're not meant to be trading stocks and currencies and commodities and everything else. Our emotions are not adapted to that. They're adapted to life on the savannah. And so one of the problems with markets and investing over long term is they're volatile. They have big drawdowns. You can't come up with a asset allocation portfolio that doesn't lose 20% at some point, and most probably will lose half at some period. So at least thinking about the left tail, what happens if it really does hit the fan? And we've seen in markets, US stocks have declined 80% before. Many markets, have declined 2/3. Bonds as well, if you take into account inflation. So how do you think, and we wrote this paper 3-4 years ago, how do you think about staying in the game? Meaning you have a risk for most people. Let's talk about it, stocks. I'll refer specifically to US stocks here, but this applies to thinking about anything when you have a risk. So you have a risk. The first way, if you want to hedge something, hedge the outcome, is you don't take the risk in the first place. So if you got a portfolio that's 100% stocks, simply sell some. You don't have to own 100. It could be 80, it could be 60. So you don't take the risk in the first place. Second is you diversify. We mentioned across diversifying all around the world. So that applies not just to the US, but every country. If you got all your money in Spanish or Japanese stocks, you diversify the rest of the world. You can also diversify into other assets. We mentioned bonds, real estate, commodities. I love farmland, but really just things that zig and zag when equities don't. You can add active strategies. We mentioned value, trend following. Those things tend to help at various periods. And lastly is a concept we've been talking about, which is hedging really the big left tail events, which is in many ways a cost and an insurance idea, which we will refer to as tail risk, that falls under this umbrella almost of insurance, like buying life insurance, car insurance, et cetera. And so, we have a fund that does this. Again, I don't want to spend any time on it really. It's called Tail Risk ETF, but just to show that there is a practical implementation of this. And there's a white paper that walks through a lot of this. And the concept is really that you go and, actually, let me go back. Oh, I went the wrong way. The concept is that you buy a basket of puts, and we have a white paper we can link to called Worried About the Market. It may be time for this strategy, but we modeled out what is the cost of buying puts historically and what does well. And we looked specifically at the US market, but again, this applies to any market when it had its really bad months. So down 10, down 20% in a month, really bad bear markets where it had losses of 50%. What helped hedge that? And the things you would expect to help, bonds did. Sometimes things like gold is just like its own person. Sometimes it helps, sometimes it doesn't. It's random. But on average, it helped. And then things you expect not to help really. So other global stocks, real estate, commodities, none of that helped because those are sort of risk on type of growth investments in a regime when the economies are doing well. So you said if you put together the things that would hedge, so a basket of bonds paired with a ladder of puts on the stock market, that's done a really good job. And again, I don't want to spend too much time on it, but historically you can show here's the real-time performance of the fund. The red line is stocks. The blue line is short-term treasuries. The dark blue line is the tail risk, and it's kind of hard to tease out. This goes up through June. And then the orange line is bear market funds in general. And this is a more zoomed in version of this year. You end up with a really beautiful sort of inverse exposure to stocks, and expenses are important. Talk about that. But high level, the goal of all of this is to get to the finish line. Your goal may be saving for your kids' college, university. You want to buy a vacation house in Croatia, or you want to go traveling to Africa, whatever it may be. Okay. Start new businesses, invest in early stage startups. Getting to that spot without the experience of throwing your hands up in March, or we've spoken to many investors that sold all their stocks in the financial crisis, never to buy them again. And so having this consideration of what can help me behaviorally get through this. And so the concept of tail risk, where you're paying for insurance, and historically this modeling of this strategy actually had a positive carry, but a lot of that had to do with bonds yielding 4, 5, 6, 7, 8%, and now they yield almost nothing. So pairing the bonds with puts on the stock market, I expect to be a cost going forward. But on average, it really helps when things are hitting the fan. So thinking back to March, when everyone was, watching markets overnight, there were limit down certain times during the day. People were going crazy, losing their mind. Having something to balance that's green at all, I think is, even if it is a cost, is a positive. And I'm going to get into why I probably own more of this strategy than anyone in the world, and including my company's balance sheet. As you think about true risks, a lot of people are really thoughtful about risks in general when it applies to companies. So for example, if you're a airline company, you don't want exposure to the price of oil because it goes all over the place. So people will hedge it. If you are a multinational food conglomerate, you'll hedge the cost of your inputs, whether it's wheat or corn or anything else, because they're too volatile. And as you think about human sort of capital, a lot of us that have jobs, one of the worst things you can do is invest all your money in your company's stock, right? Because you already are levered to that company's outcome. And so many people will then invest a bunch of money in their own company's stock. And it's like doubling, tripling, quadrupling down. So as an example, and let me preface this by saying no one else on the planet believes this other than me. So it's a very non-consensus view. And that is, theoretically, if you are in the financial world, so those of us listening to this that earn their living from investing, particularly if you're a financial advisor, you're actually like 5 times leveraged to the stock market. You own stocks in your own portfolio, which is great. But also if you're fee generating or a broker, you're exposed to your clients owning stocks. And so if stocks go down by half, your revenue goes down by half. Clients tend to panic and lose their mind when things get really bad. So they often withdraw. So you're exposed to that additional risk. And lastly, if you work for a company, you don't own your own company, that's exposed to the economic cycle. And everyone has experienced this, not just this year, but for the past 10 in certain countries. This feels very real. Your job security is also related to the stock market returns. And so it's like 5 times leverage, one risk. You can make the argument that hedging, or at least having some exposure to the downside of this one outcome that dominates all the others, is a thoughtful exercise. And this is meant as most people don't need this. For the same reason most people don't need certain types of insurance for your house burning down. You're certainly happy if you have it. But if you can get to the finish line, if you're rational, if you have an investing approach, a written investing plan, some sort of systematic approach, you probably don't need this. But if you, I think this is useful from the standpoint of at least walking through potential outcomes and considering ideas of hedging possible outcomes. Okay, so I'm gonna wind down so we can have a lot of time to chat. If things got a little wonky quick, I apologize. But as you think about your whole portfolio, I think the best thing anyone can do is be a student of history, look at all the potential outcomes of what's worked, what hasn't worked, and consider adding some tweaks based on where we are in sort of the cycle. I think that thoughtful ones include valuation. And we like to use the words, we had a few conversations on the podcast with Howard Marks, who said, calibrate. Rob Arnott, a research fellow, has talked about over rebalancing. None of my takeaways are you have to go put all your money in Greece and Brazil and Russia for stocks because of valuation. Rather, it's like just start to tilt away. It doesn't ever have to be an all or nothing decision, but valuations means there's opportunity all around the world, and that changes by the day on what's going on. So as markets go up, having this exposure to potential positive events is a good idea. And then we all want to stay in the game. The biggest compliment we say to anyone in investing in business is that you survive. And so surviving with your investing portfolio means you have the ability to still bet. For the gamblers out there, what's the worst thing that can happen? You lose your bankroll. And so being an investor, same thing, is you want to protect in these possible downside outcomes. And lastly, we didn't really get into it, but we were happy to chat about it, is to consider costs, which is one of the biggest inputs in investing that probably doesn't get enough attention, but is a huge determinant of outcome. And happy to talk more about that. All right, I'm gonna pause. There's an email you can hit me up at, and now we can just wrap.
Okay, so the thing, well, I have to say one thing that is really interesting is that the European people can buy ETFs that are listed in the United States, and they are not listed here. But we have come to an agreement to solve this problem with 2 brokers through our club, through Zonavalue Club. So for people, if they want to buy your funds, so this is much easier because you do the job. Or these other weirdos that you mentioned before, so they're going to have the chance to do it. So I think it's a great thing, actually, because in here we always have been a little bit short with these possibilities. So it's clear.
Great.
Yep. And MEB, I have to say that we are running out of time. So, it's a shame because I would be just talking and chatting. I have many questions. We will do something to solve the questions one way or another, maybe another interview other day or whatever, so we can complete the information. But it's been really a pleasure to have you on. And I hope the audience have enjoyed a lot. I think so, for sure. And nothing, it's been a pleasure. So we're going to keep going with the event.
Awesome. Thanks so much, guys, for having me. Look forward to catching up in person. Listeners, feel free to email me anytime if you want to chat and get deeper on any of these topics, or if you certainly find yourself in Los Angeles, come say hello too.
Sure, I'll go. Okay. Bye-bye, MEB. It's been a pleasure. Bye-bye.